Go ahead, open your phone, log into your retirement app, and look at your balance. Now look at your survivor benefits. I want you to take a long, hard look at those numbers. Because if you think moving that money into tax-free vehicles, like municipal bonds or just sitting on a mountain of cash, is going to hide you from the Social Security Administration, you are walking blindfolded into a financial slaughterhouse. And the worst part? You're the one who sharpened the knife. Listen to me very carefully right now. The system isn't broken. It's not a glitch. It is functioning exactly as it was designed. It is designed to capitalize on your grief, your ignorance, and your false sense of security. It's waiting for that one moment when you're most vulnerable to pull the rug out from under your entire legacy. Welcome back to the channel. Today we are tearing apart a fatal trap hidden deep within the gears of the American retirement system. I'm going to show you exactly how hiding your retirement income the wrong way triggers a chain reaction that will absolutely wipe out your Social Security survivor fund. Make no mistake, the IRS and the SSA are like a toxic couple that shares everything. They communicate seamlessly when it comes to clawing back your money. They just don't send you a memo explaining how they're doing it. By the end of this masterclass, you're going to understand a wealth extraction mechanism so precise, it catches tens of thousands of widows and widowers every single year. It's like a silent predator in the tall grass of the tax code. But I'm also going to give you the exact sequence of forms to stop the bleeding before it's too late. So grab a pen, take notes. Do not skip a single second of this, because in this game, the margin of error is exactly zero. To understand the trap, you have to watch the dominoes fall. And trust me, they fall fast. Let me introduce you to a real-world scenario, someone who did everything by the book, but still got crushed. Let's call her Eleanor. Eleanor is 72. 6 months ago, she lost her husband. On top of the emotional devastation, the kind that makes it hard to even get out of bed, she was suddenly thrust into the role of managing a complex financial estate. Her husband left behind a $500,000 life insurance policy and an inherited traditional IRA. She also successfully transitioned to her husband's Social Security survivor benefit. That's $2,500 a month to keep the lights on and the property taxes paid. Like any sane person trying to protect her nest egg, she sits down with a completely average, run-of-the-mill financial advisor. This guy looks like he walked out of a Safety First brochure. He tells her, "Eleanor, we need safety. We need tax-free income. Let's take a chunk of that cash and buy municipal bonds. The interest is federally tax-free. The IRS won't touch it, and it won't impact your day-to-day taxes. You'll be invisible." Eleanor agrees. It sounds perfect, right? Who wouldn't want tax-free money? She sets up her portfolio to generate $25,000 a year in bond interest. She leaves the IRA alone, thinking she won't touch it until she's forced to. She goes to sleep thinking she outsmarted the tax man. She thinks she's wearing a financial invisibility cloak. Wrong. She didn't buy safety. She just armed a ticking time bomb and handed the remote to the government. You see, Eleanor made the biggest mistake you can make in retirement. She confused tax-free with invisible. 2 years later, Eleanor walks to her mailbox. It's a sunny Tuesday. She pulls out a letter from the Social Security Administration. She opens it, and her heart doesn't just drop, it hits the floor. The letter informs her that her Medicare premiums are skyrocketing. They aren't just going up a little, they're jumping by hundreds of dollars a month. And here's the kicker. Social Security is just going to automatically deduct this massive new premium directly from her survivor check. Her $2,500 a month? Slapped, slashed, gutted. Why? Because she just triggered the first domino in a sequence that the system loves to use against people like her. It's called the widow's penalty, combined with a nasty little acronym called IRMAA. And trust me, IRMAA is not your friend. Let's pull back the curtain on the law because Eleanor is currently staring at that letter in total shock, wondering how tax-free money could possibly cause this much damage. The culprit is a four-letter acronym that sounds like a sweet old lady's name, but acts like a debt collector. IRMAA. IRMAA stands for the Income-Related Monthly Adjustment Amount. It is a brutal surcharge tacked onto your Medicare Part B and Part D premiums if the government decides you make too much money. But here is the truly sadistic part. Medicare doesn't look at what you're making today. They use a 2-year look-back period. The premiums Eleanor is being forced to pay today are based on the tax return she filed 2 years ago. Think about that. The government is judging your current lifestyle based on a version of you that might not even exist anymore. In Eleanor's case, 2 years ago, her husband was still alive. They were a team. When her husband was alive, they filed their taxes as married filing jointly. That's a massive shield. For a married couple, the IRMAA surcharge doesn't even kick in until your income crosses roughly $206,000. That's a pretty high ceiling for most folks. You feel safe up there. But the very second her husband passed away, Eleanor's tax filing status didn't just change, it plummeted. She became a single filer in the eyes of the IRS. And this is where the widow's penalty turns lethal. The threshold for a single filer to pay extra for Medicare drops to just over $103,000. The threshold was cut exactly in half. But did Eleanor's bills get cut in half? Did the property taxes on their home vanish? No. Her household income stayed relatively high because of the bonds and the IRA, but her tax safety net was shredded. Now you're probably thinking, but wait, you said her income was tax-free. She bought municipal bonds. The IRS shouldn't even see that money, right? Wrong. And this is the part where most financial advisors fail their clients. I need you to burn this into your brain. Internal Revenue Code, Section 86. It is the secret weapon the government uses to peek into your private accounts. When the Social Security Administration calculates your IRMAA, they don't look at your taxable income. They use something called MAGI, Modified Adjusted Gross Income. And the formula for MAGI is a trap designed specifically for people who think they're being clever. The formula explicitly forces you to take your adjusted gross income and, get this, add back every single penny of your tax-free municipal bond interest. Eleanor thought she was being invisible, but to the Social Security Administration, those tax-free bonds were glowing like a neon sign. Her late husband's final earnings, plus her new survivor benefits, plus that invisible $25,000 of bond interest, it pushed her violently over the single filer threshold. The SSA saw everything. They didn't care that she was grieving. They didn't care that her husband was gone. They just saw a single person making over the limit. So they slapped her with the IRMAA surcharge, and her monthly survivor check, the one she relies on for groceries and utilities, was gutted before it even hit her bank account. But here's the scary part. IRMAA is just the appetizer. The real feast for the IRS is about to begin. Because now that Eleanor's income has been slashed by these new premiums, she's starting to panic. She's looking at her bills, looking at her shrinking check, and she's feeling the walls close in. She needs cash. She needs it fast. And she looks at the one thing her husband left her that seems like a lifesaver, that inherited traditional IRA. She thinks, I'll just take a little bit out to cover the gap. She's about to trip a second wire. And this one doesn't just result in a higher premium, it results in a total financial meltdown. We're talking about the Secure Act 2.0, a law that most people haven't even read, but one that is currently waiting to bite Eleanor for 25% of her money. Are you starting to see the pattern? The system doesn't attack you all at once. It waits for you to make one logical move to save yourself, and then it uses that move to trigger the next penalty. So Eleanor is panicking. She's bleeding hundreds of dollars a month to Medicare because of those tax-free bonds. Inflation is hitting her at the grocery store, her property taxes are due, and her survivor benefit has been chopped. She needs cash, and she needs it yesterday. She looks at that inherited traditional IRA her husband left her. She thinks, this is what it's for, right? An emergency. She logs into her account and hits withdraw. She pulls out $40,000 just to create a safety net. She thinks she's solving the problem. In reality, she just walked straight into a buzzsaw. She just triggered domino number 2, and this one is fatal. What Eleanor didn't know and what her average advisor didn't warn her about is a nasty little detail in the Secure Act 2.0. See, her husband passed away in June before he took his required minimum distribution, or RMD, for the year. Under the new law, if the original owner of an IRA dies before taking their RMD for that year, the beneficiary, that's Eleanor, absolutely must take that money out by December 31st of that same year. Eleanor was too busy grieving. She was too busy picking out a casket and hosting a wake to be reading the fine print of the tax code. She missed the deadline. And because she missed it, the IRS doesn't just send a polite reminder. They slam her with an automatic 25% excise tax penalty on the amount she was supposed to withdraw. Let's be clear, that's not regular income tax. That's a pure thanks for playing penalty on top of the taxes she already owes. It's like a parking ticket from hell that costs thousands of dollars. But the nightmare doesn't end there, not even close. Remember that $40,000 panicked withdrawal she made? Since it came from a traditional IRA, every single cent of it counts as ordinary income. And this is where the system completely wipes out her Social Security survivor fund. I need you to write this down because this is the formula they don't want you to understand. It's called provisional income. The IRS uses this formula to decide how much of your protected Social Security check they can actually tax. Here's the math. You take your adjusted gross income, you add back that non-taxable bond interest, and then you add 50% of your Social Security benefits. For a single widow like Eleanor, there is a red line at $34,000. If your provisional income crosses that 34 grand mark, the government gets a license to kill. Up to 85% of your Social Security survivor benefits suddenly become fully taxable at your highest marginal income tax rate. It's like being taxed twice for the crime of being a survivor. Let's do the brutal math for Eleanor. The $40,000 IRA withdrawal, that's in the formula. The $25,000 in tax-free bond interest, that's in there too. Half her survivor benefits, yep, added up. It blasts her provisional income into the stratosphere. She's not just over the line, she's miles past it. Think about the irony here. Because she tried to hide her money in municipal bonds, she got hit with IRMAA. Because she got hit with IRMAA. She panicked and pulled from the IRA. Because she pulled from the IRA improperly, she got hit with a 25% Secure Act penalty, and she pushed 85% of her survivor check into the highest taxable bracket. Her tax bill doesn't just go up, it explodes. Her survivor fund is functionally wiped out. The trap has snapped shut. She's sitting in a house she can barely afford to heat, looking at a retirement account that's being eaten alive by penalties, wondering how playing it safe ended up being so dangerous. If you're feeling a knot in your stomach right now, good. That means you're paying attention. But don't look away yet, because we aren't here just to talk about the disaster. We're here to talk about the solution. In the next few minutes, I'm going to give you the exact step-by-step sequence of operations to dismantle this trap. There are 3 specific forms you need to know. If you do this right, you can win. Take a breath. Seriously, breathe. If you or someone you love is caught in this exact nightmare, I need you to listen to me. It is not game over. You don't just have to sit there and let the system grind your legacy into dust, but you have to move fast and you have to move precisely. If you call the Social Security customer service line to complain, you're wasting your time. Those reps are reading from a script. They don't know tax law and they aren't paid to save you money. You don't panic. You execute. Here is your exact masterclass level sequence of operations to dismantle this trap. Sequence is everything. If you do this in the wrong order, you'll lock in the damage permanently. It's like trying to defuse a bomb. You have to cut the right wire first. Step 1, neutralize the IRMAA surcharge immediately. You have to break that 2-year look-back rule. The IRS legally allows you to bypass the look-back if you've experienced a life-changing event, or an LCE. And guess what? The death of a spouse is the ultimate LCE. Do not wait for the appeal deadline to expire. You need to go to ssa.gov and download Form SSA-44. It's titled Medicare Income-Related Monthly Adjustment Amount, Life-Changing Event. This is your get-out-of-jail-free card. Go straight to step 1 on that form. You'll see a list of checkboxes. Check the box that says death of spouse. In step 2, put the exact date your spouse passed. In step 3, you're going to project your current much lower income for this year. By submitting this form, you legally force the Social Security Administration to stop looking at the past and start looking at your current reality. The IRMAA surcharge gets erased. The bleeding stops. Step 2, waive that 25% Secure Act penalty. Do not just pay the IRS. I don't care what your CPA says. If they tell you to just pay it, find a new CPA. The IRS code actually has a heart when it comes to reasonable cause. Download IRS Form 5329. Navigate to Part 9. On the dotted line next to line 54, I want you to physically write the letters RC. That stands for reasonable cause. But here's the secret sauce. You have to attach a formally written letter. Tell them the truth. My spouse passed away. I was in a period of extreme grieving. I was unaware of the year of death RMD requirement under the Secure Act. I fixed it the second I found out. The IRS almost always grants this waiver for survivors. They aren't monsters. They just operate on paperwork. Give them the paperwork and that 25% penalty disappears like it never happened. Step 3, control the withdrawal sequence. From this day forward, you have to be the guardian of your provisional income. Never, ever take a lump sum withdrawal from an IRA just to pay bills if it's going to push you over that $34,000 cliff. If you need cash, you pull from your regular savings or the principal of your brokerage accounts first. You have to monitor your MAGI like a hawk. If you manage your capital gains precisely, you can keep your provisional income below that red line. That means your Social Security survivor benefits stay completely tax-free. Listen to me. The government isn't necessarily evil, but the system is profoundly apathetic to your survival. It's a labyrinth of secret brackets and automated penalties. It relies on the fact that when you're grieving, when you're exhausted, when you're suddenly alone, you'll make a mistake. And the second you make one innocent mistake, like buying a tax-free bond, like the gears start turning. You have to be the architect of your own defense. No one is going to save your retirement but you. If this video opened your eyes, if it made you realize how fragile your security actually is, then you have a duty right now. Hit the like button so the algorithm pushes this to someone else who is drowning in red tape. Share this directly with your parents, your spouse, or anyone stepping into the danger zone of retirement. Subscribe to the channel because we're going to keep tearing down these walls and giving you the blueprints to fight back. Stay sharp, protect your legacy. I'll see you in the next masterclass.